The really big macro picture right now is that the economy is slowing down. So we have consumers chewing through their savings and getting to a point where they're going to have to cut back on their spending. We have interest rates going up, and we have inflation, which is slowing, but still elevated. So remember, as inflation slows down, it doesn't mean prices go down. It means prices go up slower. So we see that happening. And that combination of things is now affecting people's ability to buy houses.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB & Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 377. Anyone paying attention to the economy lately is aware that interest rates are rising, inflation has become an issue, and we may or may not be heading into a recession. What does all this mean to us as real estate investors and rental property owners? To put all this economic data into perspective, I'm excited to have Dr. Paul Isely on the show with me today. Dr. Paul Isely is currently Associate Dean and Professor of Economics for the Seidman College of Business at Grand Valley State University. Since 2013, he has also led the economic forecasting team in the Seidman College of Business, helping businesses across West Michigan have better information for decision making. And Paul spoke several weeks ago to a standing room only crowd at the RPOA annual conference. And I'm thrilled to have the opportunity to bring him back to our RPOA audience. Paul, welcome to the show.
Thank you for having me.
Bring us up to speed. What's going on in the economy? There's a lot of uncertainty. What do you see?
The really big macro picture right now is that the economy is slowing down. So we have consumers chewing through their savings and getting to a point where they're going to have to cut back on their spending. We have interest rates going up, and we have inflation, which is slowing, but still elevated. So remember, as inflation slows down, it doesn't mean prices go down. It means prices go up slower. So we see that happening. And that combination of things is now affecting people's ability to buy houses.
Does that mean that housing sales are going to plummet? Prices are going to plummet? What do you see happening there?
Well, we've already seen a big pullback in total number of sales. We've seen the price indices for most of the country start to drop as we got into the second half of last year, but just slowly. All right. Here in West Michigan, we don't really expect to see much of a drop. We'll have some, but we don't expect to see the same level of drop because we have a lot of young people who live here and they want to be in a house.
Talking about housing prices dropping, I'm hearing a lot in the news about how in some of the primary or secondary cities, prices are dropping 10 to 20% on the housing stock. But if you go back 2 or 3 years, they've actually risen 40%. So is this really a real problem, or is it just kind of bringing us back to reality?
And in many ways, we overshot because during the COVID time, people were moving out of multifamily into single family and really pressuring that single family price up, mostly because they didn't want to live near anybody else. All right. Now, as we start to move through things, we start to see that people are going to have to start moving back into multifamily because they don't have the money to maintain the single family, or fewer people are going to be able to make the move than we've seen before. So that starts to take a little bit of pressure off at the single family side. If we look at the total and we look at how much prices should change over time versus how much they did change over time, nationwide, we're looking at a 10 to 15% correction. Okay. Here in West Michigan, we're looking at a 5-6% correction. So if it happens, and remember, a correction can either happen because prices drop or because prices don't keep going up for a while and inflation catches up.
Why is West Michigan different? Why are our metrics a little bit better?
Here in West Michigan, we're blessed with a lot of millennials. So if you actually look in the region, we have more people in their 30s than we have above the age of 65. And as a result, you have a bunch of people on the beginning of their journey through property ownership or through their rentals through time. And because we're able to draw young people here, because employment continues to go up, because the economy continues to outperform what we see in most of the country, there's going to continue to be demand for housing. On the other side, because interest rates went up, people can't get out of their houses. So they don't want to give up their 3% interest rate and switch to a 7% interest rate. And as a result, we've seen a pullback in the total number of houses for sale. And that combination of things will help support prices here.
Now, Paul, every time I hear you speak or see you speak, you always bring like incredible charts and your analysis. I'd like to switch over to share some of those charts and analysis and just let our listeners know that you can also find us on YouTube. If you just Google the RPOA podcast, you'll be able to watch this video and see Paul's slides. So, Paul, would you like to pull up your presentation there?
Again, with all of the work that I always do, I always start with how have I done? So this particular graph shows the difference between what I project employment to be at the end of the year when I start at the beginning of the year here in West Michigan. And so I take what actually happens and I subtract what actually happens from what I predicted. So what you can see is in every single year since 2014, except for 2020, our predictions have been highly accurate. And in 2020, in January, we didn't fully grasp what COVID was going to be. So we didn't quite build in quite the devastation that happened. So this gives you an idea of where we're at. I'm going to remind people that past performance does not guarantee future success. The lawyers like me to say that, but this is what my team has been able to do. We've also been highly accurate on prices in the last few years. So at the beginning of 2022, the Federal Reserve prediction at the end of the year was for 4.5% inflation. We called for 6.5% inflation, and the measure that we use showed 6.5% inflation.
You were right on target with that one.
We were right on target. Being right on target is a little bit of luck, but being in the ballpark is always important to us so that you're actually making decisions based on whether prices are going to accelerate or decelerate. All right. So the story as we started here was that we have this big pile of money that's left from the stimulus, and it's in people's savings accounts. That combined with starting to fade, and that combined with higher interest rates is going to place a drag on the economy and start to slow it down. All right. So I'm going to go through a couple quick pictures here to help you see that. Okay. So the drag on the economy has begun. The first place to look is here. So you can see this is interest rates. And the orange is the Fed funds rate. And the blue is the 30-year mortgage rate averaged across a month. Okay. And this last point here is February of 2023 and February of 2023. So you can see that really fast increase in interest rates over the course of 2022 and is mirrored over here in the mortgage rates. So we can see that happening. What's important to see is this red arrow. You can see that during normal times, there's about 3 percentage point gap between the two. All right. So if you look over here, that's not a 3 percentage point interest rate gap. And so what happened is during the winter, things slowed down while people were trying to figure things out. Some of the sales got pulled forward into last summer. And so therefore, we saw a drop in that mortgage rate compared to the federal funds rate. But as we head into summer, you should expect that this 3 percentage point gap is going to reoccur. So 1, 2, 3 puts us at about 7.5 percentage points, even if the Federal Reserve does nothing else to increase interest rates. And we would expect that they're going to do more to increase interest rates. We're protecting between another half a percentage point and another full percentage point, which could suggest that as we get closer to the end of the summer, we're going to be closer to an 8% 30-year mortgage rate.
So when you say a 0.5% to a full percent increase, is that for throughout the whole year of 2023, or is that just getting us into summer?
That's for the full year. The Federal Reserve is starting to say that it might do even more. But part of the issue is that things are going along better than we expected. Number one, because those more interest rates that people actually pay, like the mortgage rate, haven't felt the full increase yet. And they will as we get closer to summer. And secondly, people have a lot of savings left from COVID. And that savings that they have left is allowing them to buy stuff, even though they're not generating enough income to do it. So you can see this worth here. So that orange line is the bottom 50% of wealth holders in the United States. So this is not rich people. These are people who are on the bottom half of the wealth standard. And what we can see since the start of COVID, their net worth has increased basically 140%. So they have a lot more wealth than they did before this all started. Even that next group of people has seen a 20% increase in wealth. We've never seen that type of thing happen during a recession. It just doesn't happen. Normally, poor people get even poorer during a recession. All right. Here, they got more wealthy. And we can see that here with their savings, because we can see that big spike in savings that happened in April of 2020. And that's the stimulus checks coming out, combined with the fact that nobody could spend any money because they were sitting on their couch. All right. And then you can see this little bobble that happens right at the end of 2020. That's that last set of stimulus checks that happened before President Trump left office. And then we see the second spike that happens in March and April. And that's the next set of checks that came out at the beginning of the Biden administration. So we have this huge buildup in savings that happened. But what's important to look at is here at the very end, you can see the savings is now well below what it normally is. And normally you can look back to 2018. And that tells us that people are starting to eat into their savings. And as they eat into their savings, as this pile of wealth and savings starts to disappear, then they're going to have to cut back more strongly on their consumption. So we've already seen it. We've seen people move from Macy's to Target, from Target to Walmart, from Walmart to the dollar store. We've seen people move from buying luxury goods to buying more food and spending money on necessities as opposed to luxuries. So we're already seeing people change how they consume.
Does this then affect the chart you showed earlier about people's net worth going up 120%? Is that net worth then coming back down because the savings are being depleted?
Yes. So they're going to be eating into that net worth. For the people in the 50 above the 50th percentile, a lot of their wealth is tied up in stocks and housing. And we know that housing is retreating a little bit nationwide. And we know that the stock market had a bad year in 2022. So as we start to look at what it's going to look like here in the first quarter of 2023, we should expect that group had a substantial reduction in their net worth. People in the bottom 50% don't have a lot of exposure to stocks, do not have much exposure to residential real estate. And as a result, they're much more income driven. Their net worth is going to be going down because of inflation and because they're having to spend more of their income just to do what they were doing before. So here, this is an ugly graph, but just remember, orange is short run, blue is long run. So if the orange is below the blue, things are slowing down. And here you can see retail started slowing down in 2022 as those interest rates started to go up and as we started to have some of the stimulus money start to dry up. Here at the end of the year, you can see it actually drops below the red line, which means not only is it slowing, but it's shrinking. Okay. So here in Michigan, we actually saw, as we went into December, consumers pulled back enough that retailers were telling us that people were buying less stuff, right? And we can actually see that again if we look at year over year inflation adjusted retail sales nationally. So here you can see the 0% line, and you can see that since November, it's negative. What does this mean? This means that they're buying less stuff, but they're spending more money for that less stuff. So if this wasn't adjusted for inflation, the total spending would actually be going up. But in reality, all they're doing is buying fewer things and spending more on them. So this tells us that they're buying fewer and fewer things. And we can see that that really bottomed out about the summer this last year. Okay, so we really stopped seeing growth in retail sales about summer in real terms. And that's when we started to hear retailers tell us that people were shifting from luxuries to necessities. So it matches up almost perfectly with that. Okay. So what we know is consumers are slowing down. We know interest rates are going up. And we know that the combination of those two things can do only one thing: slow the entire economy down. Unfortunately, even though we're slowing down, we're still going to have prices going up. And that has a lot of concerns for us. So I want to just take a quick look at this graph here. So what this pie chart does is it divides up what we spend money on. So this yellow piece here on shelter, you can see we spend about a third of our income on shelter. We spend about a quarter of our income up here on services, a little less than a quarter on goods, and the rest of it on food and energy. Okay. The first number is year over year inflation to the end of last year. The second number is what inflation would be for a full year if things just looked like they did at the end of last year. So here you can see food inflation was running at about 11.5% year over year, and it slowed down to about 5% as we got to the end of the year. We know that that food inflation is going to continue. Food inflation affects everyone, but it affects people in the bottom 50% more because they spend more of their money on food than other groups. Okay, so it's going to affect their ability to move around within the rental market. Okay, here we have energy, and you can see energy slowed way down. So remember, we were spending $5.50 on gas mid-year, and it dropped down to about $3 at the end of the year. And you can see that here. It was up 20% year over year, but if it behaved just like it did in the last part of the year, it'd be down 20%. So that's important, but we know natural gas has had a better year because of good weather. And we know that electricity prices are going to go up in this coming year. And we know they're going to go up because the costs over this last year for electricity production were higher than what were expected. So we know that those things will actually, as we go into this year, result in this inflation probably being close to zero, not minus 20%. And in the middle of the year, people are going to get faked out because we're going to be comparing to $5.50 gas. It's actually going to slow down inflation in the middle of the year for a few months, and then that inflation is going to come back. All right. So because we're comparing to $5.50 gas, it actually shifts overall inflation by a full percentage point. So in May, June, and July, our inflation rate is going to be a percentage point lower than it would have been without that effect. And that effect goes away as we go through the fall. Okay. Goods prices have bottomed, have really tapped out, and that's because the supply chain is working again. So we're seeing drops in used car prices, we're seeing drops in new car prices, we're seeing drops in washing machine prices, everything. So here we can see that inflation was being highly driven by those supply chain problems, and that's mostly gone away. Housing we expect to speed up. And that's because people are moving into apartments that are more expensive, and they're buying houses where their monthly mortgage rates are higher than they were last year. In fact, here in Kent County, the average mortgage rate is nearly $1,000 higher now per month than it was last year at this time. Okay, so that's a big increase in the cost of doing business.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB & Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com.
That's based on people who would have bought their property within the past year and are paying the higher interest rates.
Exactly. So if you bought a $300,000 house last year versus a $300,000 house this year, your mortgage payments would be $1,000 more this year than last year.
Now, that's a substantial amount.
And that's what's driving this piece here in housing. Obviously, if you own your property, you don't have a lot of loans, you don't have them on adjustable rates, this effect will be nearly zero for you. But for people moving between apartments or people experiencing rent changes or people buying a new house, that's going to start driving this number. Okay. And goods prices are going to keep going up, and they're going to keep going up because of this. These are the wage changes. And this is what we found when we interviewed labor leaders across West Michigan. And you can see that they're still expecting 4% wage growth this year. And in restaurants, more than 7% wage growth. So we know that services are mostly labor. And if wages are going up, those prices are going to have to get passed on to us. And in fact, here in restaurants, not only is their labor prices going up, remember I started by telling you food prices would continue to go up. So the combination of those two things is a double whammy for restaurants. So this last piece here is important because it affects both the housing market and prices. And that's that we don't have enough young workers. So if we look here in Michigan, you can see the number of young people between the ages of 20 and 24 really peaked about 7 years ago. Okay. And it's been dropping ever since. And we expect that it will continue to drop through this next decade. So there's fewer and fewer and fewer young people. And because of that, if we need somebody to work fast food, if we need somebody in food service, if we need an entry-level production worker, there's fewer of them available, and that's bidding up the wages. So for young workers, we've actually seen their wages increase between 10 and 15% in the last year because there's just not enough of them. At the same time, we're seeing those older workers retire at a faster rate. The combination of those two things means we don't have enough workers.
How's that affecting the trades? Like when you look at construction of new houses, apartments, any type of commercial property, that's got to have a real effect there as well.
It has a big effect there. So you have those people coming into the front end of those trades, those journeymen, those people learning. There's a smaller pile of them available. And therefore, now those trades have to compete with others for the same workers. And so they have to drive up their wages, and those wages will then come and affect us on the production side of things. So that becomes really important. Those wages have grown high enough that we're actually seeing the young men retention rate in colleges go down because there's starting to be strong enough wages in the trades to draw them out of college to go and learn a trade. So we're starting to see that start to happen right now. I mean, that's a little scary when we think about the whole pile. Now, remember, this group, about 10 years future on, is the group who buys entry-level houses, right? So if this is 2014-ish, then about 2024 to 2027-8 is going to be still okay for housing here in Michigan, because you still have this big pile of millennials going through the system. But then as we start getting out about 10 years, we'll be replacing this big pile with this not so big pile. And therefore, there'll be less demand on the entry-level rung for housing, and it's going to start affecting things in 5 to 10 years from now in housing. But the next 5 years, we still have this big pile coming through looking for housing.
The chart you're sharing is for Michigan. Would you say that this is a trend that we're seeing across the country, or is it really location specific?
It's a trend we're seeing across the country. It's a little more pronounced here in Michigan than it is in the rest of the country, in that because we had so much economic trouble between 2000 and 2010 in Michigan, a lot of Gen Xers left. And because they left, they had their kids someplace else, maybe Atlanta or Denver or Austin. All right. That means that we're slowing down faster here because we're now getting to the kids of the Generation X. So it's a little more pronounced here in Michigan, but it's affecting everybody, every place across the country. So it's a big deal. All right. So the only question then is, can we draw people in? And we do know, whether it's nationally or here in Michigan, that we're running about 4% of the people are not working because they don't want to work. And the only way you get away with that is if you're getting enough money or you have enough savings. And so what we do know is that as that savings dries up, this group will start to come back to work. But it's not a big enough group to replace all the workers that we've lost. So that becomes really, really important to worry about. We've seen the childcare issue that was a big deal during COVID, when 9% of the people out of the workforce said they were out of the workforce because they didn't have childcare, dropped to 4%. And we expect 4% is pretty normal. So that big effect on childcare has mostly gone away, but we still have people hanging on, not wanting to work. And, not to be crass, but what convinces you to work is needing to eat. And so eventually you have to work, or you have to find another source of income. All right. So here in West Michigan, we're seeing housing outperforming the US. So if we see new building permits, this is for the United States. Again, remember, orange is short run, blue is long run. So if orange is below blue, we're slowing down. And you can see that about mid-year, we really started to slow down in new building permits across the United States. So that was right on cue with the change in interest rates. We had monthly, if you looked at new housing stock, we had a 9-month supply. I mean, 9-month supplies of new housing only happens around recessions. So it was a lot of extra stock, and it's just starting to be worn off a little bit now. But here in West Michigan, remember I told you we had a lot more young people than is normal in the United States as a percentage. And so if we look here in West Michigan, you can actually see the new building permits actually speeding up as we went through last year. So we actually see construction speeding up because there's just so much demand coming in from the bottom because of all of those young people. So this is what's going to help support our prices a little bit here in West Michigan, provided we don't overbuild. And there hasn't been evidence yet that we've been overbuilding. Okay. So if we look at a typical house price over time, you can see whether you're here in West Michigan or whether you're in the United States, which is the gray line, that we all saw this big hockey stick happen in 21, 22, as those prices really accelerated away. Okay. And then we can see that slow down as we got into the second half of 22 and actually come back down. So during the very last part of the year, they actually dropped about 6%. All right. This dotted line I have is how fast we could sustainably grow the price. All right. That's really a function of how many workers we have, how fast those workers are increasing, what our housing stock is, how fast it's increasing, and the inflation rate. All right. So this is how fast we could sustainably go. So the gap between those two is the correction that's in store. And so what we can see is nationwide, that correction is about 10 to 15%. Right. And we expect that much of that will happen very quickly in other parts of the country. Here in West Michigan, we also have about a correction of about that size. But what we're seeing here is that it's trading sideways, meaning that the prices aren't going up, but they're not going down much either. So we're seeing it flatten out, and we can get rid of that gap by just doing that for a few years and letting inflation catch up. Okay. So here in West Michigan, we expect not to see substantial price gains, but we do expect that those prices won't retreat the way we see them in the rest of the country. And then if you look at the more rural areas, you can see that hockey stick wasn't as pronounced. So they'll see some retrenchment, but they won't see the same retrenchment because they didn't have the same hockey stick up.
When you say the more rural areas, for those who can't see the chart, you're talking Muskegon, Newaygo County here in West Michigan.
And whether I look at Muskegon and Newaygo or whether I look at Ionia, Barry, or Allegan, you get basically the same story. So across West Michigan, if you move out of the major metro areas, you see that it wasn't as affected as much by the rise of prices that we had during 22. So as a result, we see rents pretty much trading sideways now after having gone up last year. We see some places they're starting to go down a little bit. And this starts to be important as we start to look at things, because what we've talked about with housing is very interesting. Here in West Michigan, as the interest rates went up, the young people still wanted a house. So instead of looking for the same house that they were looking at before, they're starting to look for a smaller house. So what we're seeing here in West Michigan is a movement to try to find a house that's a little less expensive so that they can actually get into the house with the higher interest rates. Okay. But that house that they're purchasing still is going up in price. So that tells us that there's a lot of demand out there to try and buy these houses. And in fact, if you look at house purchases across West Michigan, you see a lot of purchases in that $200,000 to $250,000 range. Okay. The rest of the country is not seeing that. They're actually seeing a drop in their overall prices because there's not enough demand there to support it. But that means there's a lot of people being trapped in multifamily. And there, what we see happening is because they now can't buy the house that they were planning on buying, they want to trade up. And so we're seeing them go from a single family, from a single bedroom to a 2-bedroom. Or we see them going from a 50-year-old property to a 5-year-old property, trying to ladder up and feel more like an adult because they can't get into that house at this point. All right. So we're seeing some upward push here in West Michigan as people try and trade up. Okay. We also see movement away from higher price zones. So I have a map up now of West Michigan, but the story is really simple, that here along the lake, the further north you go, the less expensive housing is. And what we see is that people are moving from Ottawa to Muskegon County and from Muskegon to Oceana County in order to try and chase property that they can afford. And in Ottawa County, which is the most expensive county on this side of the state, we see them moving from Ottawa County to places like Newaygo, trying to find housing where they can buy a house that's a little bit bigger and avoid those higher prices. So we're seeing some movement in that way. All right. So let's just do a quick overall for you here. We see sales growth in West Michigan running about double what the US is going to see. And we see employment growth in West Michigan going about double to 3 times what the US rate is. So what we're seeing right now is a light recession sometime in the next 12 months in the United States, likely in the second half of this year. Here in West Michigan, we don't expect it. And we don't expect it because we have a lot of young people, and that will support the housing market. And we have a high exposure to automotive. And even with the higher prices, people have held on to cars a lot longer waiting to buy a car. And therefore, even though this year is going to be worse than the years that we had before COVID, it's going to be a lot better than the last 2 years in automotive because they're actually going to have computer chips to put in the cars. Okay. Those things are really going to help support us here in West Michigan. So we likely will not see the recession in West Michigan. We see, whether it's us or the United States, wage growth in the low fours. And whether it's here or the rest of the United States, we expect that we'll end the year around 5.5% inflation. So slower than last year, but still faster than many people are hoping for. All right. So I just want to note, here's the things to look at for this year. Number one, watch consumer spending. Remember, it's them using up their savings that's going to slow us down. So you want to be watching for news about consumers backing off. And that will tell you that as that starts to happen and you start to hear more news like that, we'll be within a few months of a recession. You want to be watching the Federal Reserve. We said between 50 and 100 basis points, meaning a half a percentage point to a full percentage point. If they go more than that, we're going to be looking at a recession sooner and deeper than what we talked about. All right. Supply disruptions have been getting better. If they stop getting better, that will affect things. And we have inflation expectations built in. So think about it. Have you gone and bought something now because it's going to be more expensive next month? If that's in your mind, then you're pulling purchases forward and really increasing that inflation rate. All right. And that's what happened in the 1970s. You need to buy this car today because next month it's going up in price. So they kept doing that and the prices kept going higher. It's these inflation expectations that the Federal Reserve is trying to drive out. And if they have to do it, crank down even harder to get rid of them, they say they're going to do it. All right. So if they get up there into 1.5% inflation, remember that starts as a change in interest rate over the course of 2 years, started looking like 1982. And that could be a much larger recession than what we're predicting right now. Okay. Understand we also have a budget showdown happening. If that goes awry, it could really affect our overall economic position here. And we have the mid-year fake in inflation that I've already warned you about. So be watching for those. So that's my big pieces of things to worry about. So I'm going to stop sharing so that we can talk through other things that you want to.
I want to ask you about inflation expectation and then the Federal Reserve action, because the Federal Reserve, I think, what is it, a 2% inflation target they're trying to hit?
Not this year. It's 2% for PCE inflation. So for CPI, it's really 4%. All right. So they use a slightly different measure of inflation, and there's about a 2 percentage point gap between CPI and PCE. The Federal Reserve's 2% is on PCE. So remember, I'm calling for 5.5 CPI at the end of the year. So that's getting much closer, but is not there yet. So we don't expect that they'll hit there. And in reality, I don't think that they're planning on hitting 2%. I think that they're planning on hitting higher than 2%. And the reason for this is their dual mandate. Their dual mandate is lower inflation, but also full employment. So they're supposed to take both things into account. About 3 years ago, they said, yes, what we're going to do with that second piece is we're going to worry about minority employment. So instead of focusing on the overall level of unemployment, we're going to be focusing on the unemployment level for African Americans, right? In order to get their level down, historically has required more inflation, right? And therefore, we believe that the Federal Reserve, even though they're saying 2%, really means 2.5 to 3%.
What prevents this from spiraling into something, a deeper recession? If they do raise interest rates by a full percentage point, a lot of construction will grind to a halt. A lot of housing loans will grind to a halt. it does seem like there is a chance that this could be much worse than people expect it to be.
Really, what we're doing right now is a balance between trying to slow it down with interest rates and that pile of savings that's sitting there. Okay. And normally the interest rate increases that we've already had would have been huge brakes on the economy. And the reason it hasn't done that already is that big pile of savings. So we're watching how fast that savings goes away. We're listening very closely to bankers talking. We're seeing right now that the consumer is getting more stressed. We know this because they're falling behind on automobile loans. They're starting to roll over debt on their credit cards. And that tells us that they're burning through their savings pretty quickly. All right. And that's why we believe something will happen in mid-year. Okay. If they continue to spend at the rate they've been spending, it'll happen faster. And if they eat up too much of their savings, they won't be able to buffer themselves as things slow down. And that will speed up the slowdown, which is why if the Federal Reserve starts looking at 1.5 percentage points this year, I think that we will have a much deeper recession as we get into the end of the year.
Do you have expectations that once they've kind of driven us into that recession, whether it be light or deep, that interest rates will pull back at that point?
We don't see interest rates retreating in the next year. Going more than a year out is sort of like predicting rain next year on Tuesday. We can do a good guess, but we don't see anything that causes those to retrench unless we have a deep recession. So if we start to have a deep recession, then the Federal Reserve will have to back off. We're not seeing that yet. And so we don't expect them to back off. We certainly don't expect them to retreat below the interest rates that we started this year with, even as we go through next year. So we should be expecting a higher interest rate environment for the next 1, 2, 3 years before we start to normalize. And that normal is going to be a higher interest rate than what we saw in the last decade.
Are you familiar with the housing needs assessment that Housing Next and the Grand Rapids Chamber have sponsored?
Mm-hmm. Yes.
So it shows that here in Kent County, we need 34 or 35,000 new doors by 2027. And just in Grand Rapids alone, we need 8,000 new rentals by 2027. What effect do you see the higher interest rates having on actually achieving that goal?
Well, we're already seeing some projects, particularly some multifamily projects, being put on hold a little bit because the ROI is not matching now. So what we're having to see is it's going to slow down how fast that can happen. And it's going to slow it down because of the big multifamily pieces more than the single family housing side. But if you look at the growth in population and the growth in housing, they've been matching pretty nicely for the last 5 or 6 years. The difference is that it's now nearly half multifamily, whereas 2 decades ago, there'd be very little multifamily happening. So we're maintaining our needs through multifamily, but when we now have this pile of young people trying to transition to single family. So that's creating an asymmetry. It's going to help support that single family price, even though the only way for us to even come close to those numbers is multifamily. And I mean, I'm not sure that we have enough building professionals here to build that many units in that amount of time.
Do you see similarities between the Great Recession, or is it completely different this time?
It's completely different this time. All right. And it's completely different this time because the last recession, 2007, 8, 9, 10, was caused by a financial collapse. All right. So all the plumbing behind the scenes that maintained housing collapsed. All right. We also had a lot of underwater lending happening. We're not seeing that. We're seeing nearly record amounts of equity hiding around in houses right now. We see banks with a lot more capital than they had at that time frame. So what we do know is that when it's that financial plumbing that collapses, it creates a much deeper, longer recession. That's what happened in 1929. That's what happened in 2007. We don't expect to see that. And that's why we expect this recession to be closer to something like we saw in 2001, maybe 1992, unless the Fed has to crank down really, really hard.
What is your favorite hack or app that you use in your business or life?
I can say the number one thing that I use is the St. Louis Federal Reserve data warehouse. It has virtually all the data that you ever want in time series. It's easy to grab, easy to graph. And so as you want to see what's happening in the US, that's far better than watching the news.
I know you put out a lot of incredible data and presentations. If anyone wanted to follow you or find out more about you, how would they do so?
Mostly I'm doing things through the Seidman College of Business. So if you come to the Seidman College of Business online, it's www.gvsu.edu/Seidman. We'll have some web pages there which show some of the latest research from our team. Some of it's in development right now, but it's building as we go through the year.
I want to thank you for coming on the show, being such a great ally of the RPOA and presenting at our conference every year, always standing room only and very popular. The information you share is gold, and I want to thank you for sharing it with us today.
Excellent. Thank you for having me.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.